to welcome in Eddie Ghabour, owner of Key Advisors Wealth Management. Eddie, thank you so much for joining us at the beginning of this week. I guess we'll wait for you to pop up on the screen there. There you are. I'm happy to see your face. I was happy to see you in the lineup for today. All right, let's talk about these records that we've been hitting within the market. When I look at some of the notes that I get in my inbox, they point to, momentum is on the side of the bulls. What do you make of these records and where we go from here?
So I think we're going to continue to hit new record highs. We'll get some chop here in July just due to some of the data that's coming out. But when you take a look at the overall fundamentals that's driving this market, number one is there's still a tremendous amount of pessimism and people that are not positioned for this bull run. They missed the V shape. So this is why I think these dips have been shallow, because anytime we've been getting red, I feel like these funds have been forced to buy. So you almost have like a floor on this market. So there's tremendous amount of cash on the sidelines that needs to get back in this market. There's a lot of liquidity in the marketplace. You have the dollar down, rates are down. You now have a Fed that's probably going to cut 2 times. And 2-3 weeks ago, the bond market was pricing in only 1 rate cut. And then this bill, whether it passes on by July 4th or not, we don't know. But ultimately, it is going to get passed, in our opinion, in some form or fashion. And there's going to be increased spending on the government side. And that, we've learned, that acts as fuel to the fire. And so you have a non-recessionary environment with a tremendous amount of liquidity coming into the marketplace. It's a perfect storm for the bulls. And I just hope it continues to be the most hated rally, because as long as it is, it will continue to grind higher.
Speaking of that, there's been a lot of institutional money, cash still on the sidelines. What are you expecting in terms of flows and fund flows as we kick off a new quarter tomorrow?
So we know if they have underperformed in the first half of this year, which they probably have if they're sitting in cash, they're going to have to performance chase. And this is why we think the year end is going to be really strong. July, August has a tendency to be pretty volatile to the downside. But again, we're not expecting any major drops, because I think this cash, to your point, is going to come in on red days. And so the flows are going to be net positive for the bulls, because so many people have been offsides. There's still a lot, when you look at institutional money, that's short the S&P. I feel like as higher as we go, the more negative the sentiment is continuing to get. So it's a very interesting setup, but it's really great if you are fully invested right now.
Okay, and what do you say to investors who are still skeptical of the bullish momentum and this V-shaped recovery?
I don't know what they're skeptical about. The data points are there. So, you can always find something to hang your hat on to be negative. But we say position yourself for what's happening right now, not for what you're worried about could happen in 2 and 3 years. We're risk managers by nature, so I'm always looking for what could really hit us hard and have to go to cash. And right now, it's a very compelling liquidity story, money flow story. And like you said earlier, which I think a lot of people need to really understand, is the amount of cash on the sideline that's going to have to come in. So those that continue to be skeptical is why this market is going to keep going up. So I would dollar cost average maybe 1 tranche every week for the next 4 to 6 weeks. And hopefully you'll be able to catch the back end of the year's rally.
Where do you see the best opportunities right now when you think about sectors?
So an area that we have recently added is probably one of the most hated areas. It's been a challenging space to be, but because of our outlook on the economy, is we have added small caps again. Interesting, small caps have not even gone back to their 2021 highs. And it's very hated and under-owned. So I think there's some really nice upside once we get through the summer chop for small caps. Also financials. They're getting a bid today, but when you look at non-recessionary environments and now going to a rate cutting cycle, which is where we're probably going to be heading into, is very, very good for financials. And then another area that we like is consumer discretionary. These are areas to us that when you get an economy that's going to surprise to the upside on growth over the next 6 to 8 months, these will be the areas that we think will catch a bid and can really beat the S&P on the upside.
Okay, let's talk a little bit about financials. You like XLF. Look, it's been, in terms of its performance year to date, it's been pretty strong. What's the catalyst from here for financials? Is it all about the, a more clear regulatory environment? Is it about an uptick in M&A activity? What is it about from your view?
So I think it's a combination of all of those two things that you just said, as well as the fact that, again, we're going to have an economy that we think is going to surprise to the upside over the next 6 months. So when you have an economy that's doing that, a lot of times the financials is a really good place to be, and they're great large cap names. So on the downside, a lot of times they won't be as volatile either. So it's a win-win in that scenario. But this is a bet on the fact that we're not going to a recession and growth is going to accelerate to the upside surprise.
I want to go back to your small cap thesis because, look, the last time we talked, I think you talked a little bit about this, and you said you were entering into this space. You like IWM, that ETF. So tell me about what makes 2025 the breakout year in this for small caps.
So a lot of regional banks are in small cap index. And when we go to a rate cutting cycle, I think you're going to see the regional banks outperform. And so that's really going to also be a catch-up trade. We love playing a contrarian side, and it's hard in this market to find areas that have been, from a price action perspective, really underperforming. And so it's really a contrarian play, as well as a combination. We think that the rate cycle is going to be looser. It's been really hard on these small caps to be in this tight monetary policy that we've been in. So it's been a while since we've been in a rate cutting and loosening cycle here. So that's what we think is going to happen here over the next 12 months. And they should really surprise. And I would expect that to break over that 240 mark where IWM was in November of 21.
Okay, and then really quickly, just a quick final thought on consumer discretionary. I know you like Amazon. It hasn't been the strongest performer in the Mag 7, but do you expect it to catch up?
We do. Again, this is another contrarian play. It's kind of been flat price action in this name because of fears of the recession. But I think we're going to get confirmation here over the next 3 months that we're not going to be anywhere near a recession. And that softening economy is actually going to be a bullish catalyst because that's going to have the Fed move the needle.
All right, Eddie, thank you so much. That's Eddie Ghabour, owner, Key Advisors Wealth Management. Thank you for kicking off the week with us, Eddie.